I always think about, like, if people are listening to this in their car, like, if they could ask a question, what would they ask? But any specific breakdown on those controllables, Bill? Because you got supplies and labs together, 10% in the aggregate. Like, any specific breakdown, or is it all across the board?
Welcome to Dental Momentum, the podcast dedicated to lively discussions on business and financial strategies tailored for dental business owners. At Duckett Ladd, we're committed to transforming your business journey and supporting you at every stage. Join us as we delve into the keys to long-term practice success, from cutting-edge accounting and strategic tax planning to personalized business strategies. Together, let's propel your dental practice forward with unstoppable momentum.
All right, what's happening, man? Back for episode 5 of the 6-part series.
Good to be back, man. Nothing better than talking about financial statements and key components therein, right?
There we go, man. I hope we're not boring you guys to death, but like we said, this is key information and kind of how we, train our team on analyzing financial statements and diagnosing a dental practice. So today we're continuing to, again, I always say it, you guys get tired of me saying this, but go back and listen to the first ones if this is the first one you're hearing, because they build upon each other, right? And so kind of went through the, do you have a production issue? Do you have a collections issue? And now what we're going to do is, do you have a spending issue? And we're going to break this spending down between 2 different episodes. Maybe I'll throw it to you, Bill, to kind of high level, like, what are those 2 episodes? Like, why are we breaking it down between the 2? And then let's go into the first one.
Yeah, sounds good. So, to kind of do a brief recap, as you know, we've got our gross production, the total you do, pre-write-offs, adjustments, so on and so forth. Those adjustments, write-offs create net production, which, that's kind of what we use to say, do we have a production issue? Then net production is theoretically what you can collect. What did we collect? We talked about that last time. So then we can decide whether we have a collections issue. So we've addressed the revenue cycle management, the incoming revenue. And to be honest, that's where a lot of things tend to be broken, is just either on the collection side or just not producing enough, not having enough at bats like we talked about. But there's also the component of, where do you spend your money too? And are we spending it efficiently? We've always heard the phrase, you can't save your way into prosperity or profitability. Certainly making sure you're generating and collecting what you should is going to be the lion's share of the lift, but you also want to make sure that you're spending it well. And that's what we're going to talk about these next 2 episodes, because that's an important part. And there's certain categories that are going to be a big chunk of the revenue you earn is going to go out the door. So the way we're going to split this up, Jared, is we're big believers that your profit and loss should have top line collections, and then it should begin the expense sections with one that's actually carved out called cost of goods sold. And there's certain categories are in there, but to kind of understand what cost of goods sold is, these are more of your true hard clinical cost to perform dentistry. It's your clinical team, it's your lab, it's your supplies, all those kind of things. And we'll get into a little bit more detail here in a second. But what I want people to understand is these tend to be more variable. As you're producing more, you tend to incur more costs. As you add ops, as you add associates, these costs all tend to kind of go up. When we're doing our forecasting for our CFO clients, these tend to be variable in nature, and they tend to kind of common size down into certain thresholds. So that's kind of what they tend to be. And they also tend to be, they can be key contributors in profitability, right? You can have situations where your lab and supplies get out of hand, and that affects, your profitability. Or if you have team members that aren't producing efficiently in spite of having good at bats, then that's a problem, and that's going to be a drain on your profitability. If all you're doing is paying their minimum. So this can be a big section of your P&L that's going to tell you a lot. And to kind of continue the thread, you've got your total collections up here, and then we have cost of goods sold, and included in those we're going to show clinical employees. And there's debate out there, but we're big believers that hygienists and dental assistants should be up in cost of goods sold. We think they tend to be more variable in nature. As you hire doctors, you need to hire more assistants. So we've heard that over and over, right? So we consider those to be cost of goods sold. We put those up there. And you definitely, when it comes to those expenses, or anytime you list employee expenses, you want to list every single cost you can think of that cost to employ that person. It's not just their wages, but they're going to have their payroll tax, they're going to have their benefits, things like that. You want to have all that stuff up there so you can get a true feel for what your clinical costs are, hygienist and associate. So that's we tend to see those kind of grouped together in what we call clinical cost. Now, the next one is really depends on the nature of your business. We, we like to see associates come in next. So when we're working with our big practices that, maybe have an owner doc who is a CEO and not a producer, it's very simple. All his associates or her associates are up in that line item. And again, it's all their related cost. And you want to kind of see all those costs together. When it comes to a solo doc, if possible, it's nice to see that up there, especially if it's a normalized type salary, because it really gives you a good feel for how your margins are working out. But some people prefer to have their comp and their discretionary type expenses, if they're a solo doc, down below the line. And that's fine too. I guess it's to each his own. But I personally like to see some reasonable comp up in docs, because you can really get a feel for how you benchmarked out against others. And we'll get to ratios here in just a second. So you got all your associate costs or your doc costs that kind of come in there. Yeah, so next we have what we call controllables, kind of a term we've learned from others, but really that's your medical supplies, clinical supplies, and labs. And what we tend to find is when it comes to spending operational initiatives, this is usually low-hanging fruit, Jared, where you can see people can say, hey, we're spending too much, or we don't have proper process and procedures to make sure we don't spend too much. And a lot of times we'll see initiatives that come in, and through group purchasing organizations or just better inventory management, you can see some pretty good savings off of this. Again, we'll talk through ratios here in a second, but those are the categories, man. We got clinical employees, we got associates, we got clinical supplies, and we got labs. That's what we like to see up in cost of goods sold for a general practitioner.
Yeah, that's spot on, man. I mean, you guys hearing this are probably thinking, okay, I'm looking at my profit and loss statement, and guys, like, hang tight here. I don't see cost of goods sold. Very, very, very happens all the time.
Yeah,
I mean,
sure.
it's just because going back to the speed financial statements, your profit and loss statement isn't organized like this.
Yeah.
And that's kind of what we're saying is, if it is, great, spot on. All our clients are. If it's not, that's why we recommend doing this. So that when you're looking at your profit and loss statement, you can easily see these things, broken out, if that makes sense. So, I mean, it's spot on. You need to be able to look and see what your cost of goods sold is pretty darn quick, if that makes sense, Bill.
Yeah, for sure. And again, going back to speed, like you're saying, if you're looking at your financial statement and it has total revenue and then it has 30 expense categories alphabetized, that's a problem. That's not speed financials in our opinion. So, what we failed to mention, or what I failed to mention when I'm talking about revenue minus cost of goods sold, again, clinical, associate, supplies, and lab, that equals a number. And that number is gross margin. And when we talk through our 10,000 foot metric, that's our 10,000 foot metric of what we want to see when it comes down to, are we in line with our cost structure? And so what we kind of like to see there for gross margin, again, that's revenue minus the cost of goods sold items we just listed. We like that ratio to be 50%. So in other words, that number is half of what the top line number is. So how do we get there? These are our ratios. These are what we like to see, just having worked with really good operators and kind of learned our way through it. Let's talk through the clinical. Again, this is non-doc. This is associates. This is, hygienists. This is all their associated cost. What we like to see is around 20%. That number, obviously, your employees are going to be a big chunk of your P&L, whether it's your clinical or non-clinical.
Employees are your biggest expense besides tax, basically.
100%.
Yeah.
100%. So they're always going to be the biggest. That's why it's super important to make sure that they're producing efficiently. So, we try to see that number around 20%. Usually we see the hygienists are more of a percentage-based model, and assistants are more of a wage-based model. But if that number is a lot higher than that, then we probably maybe have an issue with doc production or something we need to kind of look into a little bit further. So 20% there is what we want to see for those clinical employees and all associated cost there.
Yeah.
Next up, go ahead. We'll go to associates. Now that one can vary a little bit more too. Sometimes you'll see, Jared, general practitioner may have a specialist that comes in every now and again. But let's just say it's a pure, general practitioner who has standard associates who are on a comp model. And, what we tend to like to see is a very similar percentage. Associates should be around that 20, maybe 22% margin or ratio. It's kind of what you want to see there. And so, again, not to get too simplistic, but you think, well, shoot, aren't my associates getting comped at 30 something percent, 30, 32, whatever percent? Shouldn't it be higher? Well, this is where a healthy mix of hygiene and doctor production comes into play, because hygiene production is going to dilute that percentage down. And that's why you'll see it be at 20 as opposed to 30 or 32. If you were a doctor only practice and there was no hygiene, that number probably would be close. It should be pretty close to what what they're producing and what they're collecting on that. So doctors, again, at that 20%.
So just to jump in there real fast, I'll emphasize maybe what you just said, Bill, is this is on a GP practice. So if you're let's say a perio practice that lays a ton of all on 4, all on X deals, then that's going to be higher.
For sure.
But this is standard GP practice, basically, with the goal of a third of the production hygiene, that sort of thing.
Yeah. And this is a mix of a general practitioner, and again, every specialty is going to have a different mix and different ratios, and perhaps we can do series out there later on about those. But for now, as we focus on, these general dentists, we've got, 100% for our revenue, and now we backed off 20%, we backed off 20%. We want to get to 50%. So that leaves our controllables, clinical supplies and labs, sitting at 10%. That's where we want to see. Real life case study that, I saw in this, which I just absolutely love, Jared. This is why it's low hanging fruit, is when we first started working with one of our CFO clients, we were looking at these ratios and they were 12%. And they're like, nope, that's way too high. And when you're
12% on controllables.
Yep. And so if you're a $12 million business, top line business, that adds up pretty quick, right? And so as simple as identifying a good group purchasing organization, training the office managers on proper spending and budgeting, and incentivizing them for keeping those costs under control. And in about 9 or 10 months later, that 12% is now being minimized down to 11, and now it's sitting at under 10. And that's the low-hanging fruit, in my opinion, of the cost of goods sold spending issue. If you have a production issue or a producer issue, I should say, as far as your cost of goods sold, your clinical or your associates, that's a tougher. Anytime that you have a people issue, then it's a little bit of a tougher sled, because you have to understand why is there a producer issue. And so it's a little bit tougher. But these clinical supplies and labs, that a lot of times that's where you see a lot of low-hanging fruit, for sure.
Any specific, I always think about, like, if people are listening to this in their car, like if they could ask a question, what would they ask? But any specific breakdown on those controllables, Bill? Because you got supplies and labs together, 10% in the aggregate, like any specific breakdown, or is it all across the board?
It really depends, right? I mean, you could say 5 and 5 or 6 and 4, but like bigger practices are going to have internal labs sometimes. And so that lab may be 2% or 3% on a $18 million business, because they're doing it all in-house. But, then you may have the rest in supplies, or you may have a practice where, you do a lot of implants, or you do a lot of Invisalign or something like that. And so depending on whether you code those to lab or supplies, that it's going to kind of vary. But I would say that, just generally speaking, if you're in a healthy practice, just normal general practitioner, probably half and half, maybe 6% one, 4% the other. I mean, they usually tend to shake out where they're pretty equal unless you, again, have an in-house lab or you do a ton of specialty type work. Just a general dentist, usually we'd see half and half, I would say.
Yeah, no, that's great, man. A couple things that, I'm just thinking through that maybe I'll riff off two things. And you've mentioned this basically already, but like this, like if you're a single doc practice and you're not putting a reasonable or your equivalent of what you would be earning if you were the associate up into associate, if you will, or doctor owner compensation up in cost of goods sold, you're going to be hitting this 50% already.
Yeah,
right?
for
Because
sure.
that's going to be zero
Right.
or a lower amount. So that's why, we do kind of recommend, and maybe it's off the P&L or whatever, but put in that equivalent. If you weren't working there, what that associate would be working or would be making if they were doing your production. Does that make sense?
Yeah, for sure. And I think that's just kind of one of those things that these ratios are under the assumption that you're paying a reasonable compensation to either yourself or to your associate, and say 30, 32%, whatever it is for your production. If not, yeah, you're going to think your overhead's fantastic, but maybe it's not. Maybe you just have a job at that point, and it's not really profit. It's really compensation, that falls to the bottom line. So when we get to our next series and we get to what we call net operating income, which is the KPI to rule all KPIs, then you'll see, like, if that's super high or super inflated, then yeah, you maybe don't have your own doctor comp in there. Or if it's barely hits it and you don't have your own doctor comp in there, then you're not nearly as profitable as you probably have assumed. So that's a great point. I mean, that's why we like to see it up there, Jared, is it just really brings it down to something that we have seen over and over and can really analyze and benchmark against, industry and other practices.
Yeah, 100%. And then my second point was like emphasizing what Bill was going through in regard to the cost of goods sold being a variable expense component, meaning, as more production, as the top line increases, that cost of goods sold is a variable cost, which means you're going to have to add more producers, like providers, I guess, with hygiene or lab or whatever. And we'll probably riff on this a little more when we do the next episode, but it's really going to show the power of how adding providers, if you have the capacity to do it, makes a lot of sense if you can keep those fixed costs, which is the next episode, truly fixed, and the power of doing that and what that does to NOI in the regard to dollar amounts and how that works.
I'd say that's probably some of your most rewarding work and enjoyable work is helping work people through that model of, can I add an associate? Does it make sense? And is it not going to be a net negative for me? Is it going to be a net positive? Yep. And it when you do the modeling, it can work. Sometimes it doesn't work. I mean, there has to be some things that have to fall into place. But if you can do that, still hit that 50% margin, and your fixed costs stay the same, then you're having someone else help cover that. You can really drop some good numbers to the bottom line. But that's something to enter in strategically. And again, I've seen you work your magic with some clients where you model that out, and it's been extremely successful. We've also seen people try to add associates too early and not really have accounted for, patient flow, spacing needs, parking needs, all that stuff. And it can be kind of a mess too. So you're exactly right. It's a good way to really start optimizing and maximizing your NOI when you can do that. So that's a great point.
Awesome. Well, I hope that makes sense to you guys. I mean, the breakdown of what cost of goods sold, what goes into it, what the percentages need to look like. For a lot of you, actually, this may be the first time you've heard of gross profit or gross margin. Yeah. So hopefully this adds a little insight into what that looks like. And again, until you get the chart of accounts converted in the right spots, like we're talking about, it might not make sense, but I hope you guys realize how the simplicity, going back to speed, simple, how doing this makes it easier to read a profit and loss statement very quickly, if that makes sense. So anyway, Bill, I appreciate it, man. Next episode, we're going to dive into the NOI or the operating expense side of it, and hopefully wrap the whole thing up and talk about what the end result of diagnosing your practice looks like, though. So I appreciate it, man.
You got it.